In 2008, the global economy came closer to collapse than at any point since the Great Depression. This time, it wasn't caused by war, it wasn't caused by inflation, it was caused by the financial system itself. At the center of the crisis was the American housing market. For years, banks had been giving out home loans to almost anyone, even people with unstable incomes, even people with no savings, even people who clearly couldn't afford to repay. These were called subprime mortgages. Banks believed housing prices would always rise, so risk didn't matter. But here's where it got dangerous. Instead of keeping these risky loans, banks bundled thousands of mortgages together and sold them as safe financial products. These products were bought by banks, pension funds, and investors across the world. Risk was no longer visible, it was hidden. Credit rating agencies labeled these risky assets as safe. Investors trusted the ratings. Money poured in. Then housing prices stopped rising. Borrowers began defaulting. Homes were repossessed. Mortgage payments stopped. And suddenly, those safe financial products became toxic. Banks didn't know who was exposed. They didn't trust each other. Lending froze. In September 2008, Lehman Brothers collapsed. This single failure sent shockwaves through the global economy. Stock markets crashed. Businesses lost access to credit. Millions lost jobs. In the United States alone, over 8 million jobs were wiped out. Global stock markets lost trillions of dollars in value. Major banks were days away from total collapse. Governments had no choice. They stepped in with massive bailouts. Public money was used to save private banks. Interest rates were slashed to near zero. The world avoided total collapse, but at a cost. Trust in banks was destroyed. Inequality increased. Public anger exploded. The 2008 crisis reshaped modern capitalism. It proved that when financial systems grow too complex, risk doesn't disappear, it spreads. And when it finally breaks, everyone pays the price.